In 1990, if you bought a condo or townhouse with a homeowners association, you might pay $50 to $75 per month in HOA fees. Today, that same type of property has fees of $300 to $500 per month or more. That's an extra $3,000 to $6,000 per year on top of your mortgage, property taxes, and insurance. And here's what catches people off guard. HOA fees are legally enforceable. If you don't pay them, the HOA can put a lien on your home and eventually foreclose, even if your mortgage is current. Today, I'm going to walk you through how HOA fees went from a minor expense to a major financial burden, what they actually cover, why they keep rising, and why they've become nearly impossible to avoid in modern housing developments. Let's start by looking at what HOA fees looked like in the past and what they covered. In 1990, HOA fees for a typical condo or townhouse community ranged from about $50 to $100 per month. In a basic community, fees might be as low as $35 to $50. In a more amenity-rich community with a pool and clubhouse, fees might reach $100 to $150. These fees covered several basic services: common area maintenance, landscaping of shared spaces, exterior building maintenance and repairs, insurance for common areas and building exteriors, water and sewer for the complex, trash collection, and sometimes basic amenities like a pool or small clubhouse. $50 to $100 per month was manageable for most homeowners. It was roughly equivalent to a utility bill, something you budgeted for but didn't stress about. And importantly, single-family detached homes typically didn't have HOAs, so if you didn't want to deal with fees, you could buy a regular house. Adjusted for inflation, that $100 monthly fee from 1990 should be about $240 today. But actual HOA fees today are often $300 to $500 or more, significantly higher than inflation alone would predict. Let's look at what you're actually paying today. For a basic condo or townhouse, fees typically range from $250 to $400 per month. For communities with more amenities, pools, gyms, security, fees can be $400 to $700 monthly. Luxury high-rise condos in cities can have fees of $1,000 to $3,000 per month or more. That $400 monthly fee works out to $4,800 per year. Over a 30-year mortgage period, you're paying $144,000 in HOA fees, and that assumes fees never increase, which they always do. And here's what changed. HOAs are now nearly mandatory in new developments. Approximately 85% of new homes built since 2000 are part of HOA communities. If you want to buy new construction, you're almost certainly buying into an HOA. Even many single-family home developments now have mandatory HOAs. Several factors explain why HOA fees increased so much faster than inflation. Factor number 1, deferred maintenance coming due. Many HOA communities built in the 1980s and 1990s are now facing major repairs that were deferred for years. Buildings need new roofs, siding replacement, foundation repairs, parking lot repaving, pipe replacements, elevator upgrades. These are expensive capital projects. HOAs are supposed to maintain reserve funds for these big projects, but many communities didn't save enough. When a major repair becomes necessary, the HOA has two options: levy a special assessment where each owner pays a lump sum of thousands or tens of thousands of dollars, or increase monthly fees substantially to fund the work over time. Many communities that had low fees in the 1990s and early 2000s are now hitting these expensive repair cycles. Fees that were $150 in 2000 jumped to $400 or $500 by 2025 to cover the deferred maintenance. Factor number 2, insurance costs skyrocketed. HOAs carry insurance for common areas and building exteriors. As we discussed in the homeowners insurance video, insurance costs have exploded due to climate change, increased disasters, and higher rebuilding costs. HOA insurance costs have increased even more dramatically than individual homeowners insurance in some cases. After major disasters like Florida hurricanes or California wildfires, insurance companies raised rates for HOA master policies by 50 to 100% or more in affected regions. Some HOAs in high-risk areas struggle to find insurance at any price. When they do find coverage, the premiums can be hundreds of thousands of dollars annually for larger communities. These costs get divided among all unit owners through increased HOA fees. Factor number 4, amenity creep. Modern HOA communities often include far more amenities than older communities. In 1990, a community might have a pool and a small clubhouse. Today's communities might have multiple pools, fitness centers, tennis courts, playgrounds, dog parks, walking trails, security gates, package rooms, and elaborate clubhouses. These amenities sound attractive when you're buying, but they're expensive to maintain. A fitness center needs equipment that wears out and must be replaced. Pools need resurfacing every 10 to 15 years. Landscaping needs constant care. Security gates need repairs and technology updates. Each amenity adds to operational costs, which translates directly to higher monthly fees. And once amenities are in place, removing them is difficult because homeowners who use them resist, even if they're expensive to maintain. Factor number 4, labor and service costs increased. HOAs contract with service providers for maintenance, landscaping, management, and repairs. Labor costs for these services increased substantially, particularly in recent years. Management companies that run HOAs professionally charge fees based on the number of units and complexity of the community. These management fees have increased from about $10 to $15 per unit per month in the 1990s to often $30 to $50 per unit per month or more today. Landscaping costs, pool maintenance, janitorial services, security services, all have increased with general wage growth and inflation in service industries. Factor number 5, increased regulatory and compliance. HOA communities face more regulatory requirements than in the past. ADA compliance, environmental regulations, safety codes, financial disclosure requirements all add administrative costs. Some states require HOAs to conduct reserve studies, obtain specific audits, carry certain insurance types, and follow particular governance procedures. Compliance with these requirements costs money, which gets built into HOA fees. Factor number 6, mismanagement and corruption. While not universal, some HOAs suffer from poor financial management or outright corruption. Board members with no business or financial training make poor decisions. Management companies sometimes overcharge for services. Vendors may charge inflated prices, particularly if they have relationships with board members. There are documented cases of HOA board members or management companies embezzling funds, awarding contracts to friends or family at inflated prices, or making financial decisions that benefit themselves at homeowners' expense. When funds are mismanaged or stolen, the community still needs to pay for services, which means legitimate expenses must be covered by raising fees even higher to make up for the losses. Let's break down where your monthly HOA fee actually goes in a typical community. A significant portion, often 30 to 40%, goes to physical maintenance, landscaping, common area cleaning, pool maintenance, building exterior repairs, parking lot upkeep, and similar services. Insurance often consumes 20 to 30% of the budget. Master insurance policies for the building and liability insurance for common areas can be the single largest line item in high-risk areas. Management companies' fees typically take 10 to 20%. Professional management companies handle day-to-day operations, financial management, vendor coordination, and compliance. Utilities for common areas, water, electricity, gas for clubhouses, pool heating, parking lot lighting, might be 10 to 15% of the budget. Reserve fund contributions, money set aside for future major repairs and replacements, should be 10 to 20% of fees, though many HOAs underfund reserves. The remaining portion goes to administrative costs, legal fees, accounting, taxes, banking fees, and other operational expenses. Importantly, HOA fees are ongoing and generally only go up, never down. Even if your individual unit needs no work, you're paying for the shared infrastructure and services for the entire community. Here's something that surprises many homeowners. HOAs have significant legal power to collect fees, including the ability to foreclose on your home. When you buy a property in an HOA community, you agree to the CC&Rs, covenants, conditions, and restrictions, which are legally binding. These documents give the HOA the right to assess fees and enforce payment. If you don't pay your HOA fees, the process typically goes like this. First, you receive late notices and the HOA adds late fees and interest to your balance. Then, the HOA may place a lien on your property, which is a legal claim against your home for the debt owed. If you continue not to pay, the HOA can initiate foreclosure proceedings. In many states, HOA foreclosures are non-judicial, meaning they don't require going to court. The process can be faster and less expensive for the HOA than a judicial foreclosure. Here's what's particularly concerning. In some states, HOA liens take priority over mortgage liens. This means if your property is foreclosed and sold, the HOA gets paid first, potentially wiping out the mortgage lender's interest. While federal law provides some protections for mortgages, HOA foreclosures can still happen. There are documented cases of people losing their homes over unpaid HOA fees. A homeowner falls behind on a few $100s in fees, late fees and legal costs pile up to several $1,000s, they can't pay the accumulated debt, and the HOA forecloses. The home is sold, often at auction for below market value, to cover the HOA debt and legal costs. In some notorious cases, investors buy up HOA debts for pennies on the dollar and then aggressively pursue foreclosure to take ownership of properties. A debt of a few $1,000s in unpaid fees can result in someone losing a home worth hundreds of thousands of dollars. Even if you're current on your mortgage, if you're behind on HOA fees, you can lose your home. This power imbalance has led to calls for reform in many states, but the legal framework generally still favors HOA's ability to collect. The fundamental problem for homebuyers is that HOAs have become nearly unavoidable in modern housing. Developers prefer creating HOA communities for several reasons. First, HOAs handle ongoing maintenance of common areas and infrastructure, which means the developer can hand over responsibility after selling units. Without an HOA, the municipality would have to maintain those areas, and many cities prefer not to take on that burden. Second, HOAs can enforce aesthetic standards and rules that help maintain property values, at least in theory. This makes the development more marketable to buyers who want assurance that neighbors won't let properties deteriorate. Third, in some cases, municipalities require developers to create HOAs as a condition of approval for new developments. The city doesn't want to maintain private roads, stormwater systems, or other infrastructure in new subdivisions, so they require the HOA structure. For condos and townhomes, HOAs are essentially necessary because residents share common structures and systems. You can't have individually owned units in a shared building without some mechanism for maintaining shared elements. But increasingly, even single-family detached home developments have mandatory HOAs. A new subdivision of individual houses on individual lots still has an HOA that maintains entrances, common areas, maybe a neighborhood pool or park, and enforces rules about home appearance, parking, and property use. The result is that if you want to buy new construction, particularly in growing suburban areas, you're almost certainly buying into an HOA. The percentage of American homeowners living in HOA communities has grown from about 2% in 1970 to about 27% today, roughly 74 million people. If you want to avoid HOAs, you're limited to older existing homes, which are becoming more expensive relative to new construction, or you need to buy in areas without new development, which often means being farther from job centers and amenities. For people already living in HOA communities or considering buying into one, there are some things to understand and strategies to consider. Before buying, carefully review the HOA's financial documents. Ask for the most recent budget, reserve study, and meeting minutes. Look at the reserve fund balance. Is it adequately funded for upcoming major repairs, or are special assessments likely? Review the fee history. How much have fees increased over the past 5 to 10 years? A community with stable fees might be well managed. A community with rapidly increasing fees might have financial challenges. Check the rules and restrictions. Some HOAs have extensive rules about what you can and can't do with your property. Understand what you're agreeing to before buying. If you're already in an HOA, attend meetings and participate in governance. HOAs are member-run organizations. If you don't participate, decisions get made by whoever shows up, which might not represent your interests. Consider running for the board if you have concerns about how the HOA is managed. Board members are typically volunteers from the community. You can influence decisions about spending, fee increases, and management. If fees increase substantially, review the budget and ask questions. HOAs are required to provide financial information to members. Make sure increases are justified and funds are being used appropriately. If you face financial hardship and can't pay fees, communicate with the HOA immediately. Some HOAs will work out payment plans rather than immediately pursuing liens and foreclosure. Don't ignore the problem, as it only gets worse with late fees and legal costs. For future home buyers, factor HOA fees into your affordability calculations. A home might seem affordable based on the mortgage payment, but adding $400 per month in HOA fees significantly affects what you can actually afford. HOA fees went from $50 to $100 a month in 1990 to $300 to $500 or more today, due to deferred maintenance, skyrocketing insurance costs, increased amenities, higher labor costs, more regulations, and in some cases, mismanagement. These fees are legally enforceable, and HOAs can foreclose on homes for unpaid fees. Meanwhile, HOAs have become nearly unavoidable, with 85% of new homes built since 2000 in HOA communities. For many homeowners, HOA fees have become a significant ongoing expense that rivals property taxes or insurance. Understanding what drives these costs, what your fees cover, and the legal power HOAs have helps navigate this aspect of modern homeownership. If you found this useful, share it with other homeowners or people considering buying in HOA communities. Leave a comment about your HOA fees and experiences, and subscribe for more videos on homeownership costs. I'll see you in the next one.